Hello friends, today we are going to talk about the banking sector reforms. It has again come back to focus with Manthan 2022 held recently to work out strategies to take the banking sector reforms of public sector banks ahead. Now, the banking sector reforms in India have started in 1991 with the recommendations of Narasimham Committee 1. Later on in 1997, Narasimham Committee 2 added on some of the reform measures. And when we see those kind of recommendations together with the advancement of technology, that is core banking solution, there has been a rapid transformation in public sector banks. But what is more significant is in 2015, there was Gyan Sangam 1 which was held for a collaborative meeting between the banks and government on one side, regulators on the other side. So there was a lot of mind meet as far as Gyan Sangam 1 was concerned. As a result of the discussions held in Gyan Sangam 1, Government of India has rolled out a 7-pronged strategy which is known as Indradhanush. Now, Indradhanush reforms has been a game changer in public sector banks reforms. There were 7 most important recommendations. That is why it is known as a 7-pronged strategy or Indradhanush. But the most impactful reforms has been number 1, the formation of Banks Board Bureau to give more autonomy to the selection of top leaders of the banking industry, that is mostly the whole-time directors of the banks, public sector banks. Then came the second most important change is the separation of the position of Chairman and Managing Director, CMD, into 2, that is Chairman, Chairman to be the what you call a non-executive position, and Managing Director and CEO to be the leader of the banking top management team, to be the whole-time director on the board of the bank. CMD used to be the single position of whole-time director as far as Chairman and Managing Director is concerned. Of course, executive directors were there and they continue to be there even now, but the position of CMD has been bifurcated into 2. 1, the Chairman, the non-executive director on the board, and the MD and CEO, the whole-time director on the other side, to lead the team of the bank. That was a big change that has come. And the third, we can club them into operational freedom to the banks to recruit directly from the market. There is the lateral recruitment. Then came the de-stressing of the banks from the perils of NPAs, because NPA has been a very limiting factor as far as the banking system is concerned. So those kind of things were, and also for permitting banks to issue ESOPs, that is equity stock options, they were all permitted. So a group of recommendations under Indradhanush has changed the way in which the governance used to take place in the public sector banks, and that has brought a lot of good change to the banking system. And in between, direct recruitment of private sector people into the public sector banks were also tried. And now, of course, we are back to the banking stream as far as recruitment of chairman and managing directors are concerned. But the big change on the governance has come from, very briefly, if you put, Indradhanush has been a differentiating factor. Then, after that, Reserve Bank of India has started what is known as AQR, that is Asset Quality Review, because there was a lot of divergence between the NPA data of the banks and the NPA data of the regulators. So that has caused a lot of concern, and Reserve Bank of India wanted to assess the actual state of the asset quality of the banks, as a result of which they have set up what is known as asset quality review, and they have also stopped the facility of restructuring of loans, and that forbearance has been withdrawn. These two aspects have come to tackle the non-performing assets. So that has brought a lot of change, in the sense that there was a huge spike of NPAs between 2015 and 2017. And also up to 2018, there was a huge rise in the NPA levels in the public sector banks because of correct classification of the NPAs, and correspondingly the stock of restructured assets have come down logically, because many of the restructured accounts have become substandard accounts, and they have been added to the portfolio of the NPA accounts. As a result of which, when the pile of NPAs increased, then Government of India wanted to infuse substantial capital to the public sector banks to comply with the Basel II and Basel III regulations, as a result of which Manthan 1 was held in 2017. Now, capital cannot be infused in the public sector banks without corresponding demand for performance from the public sector banks. As a result of which, during Manthan 1 2017, ease banking sector reforms were rolled out. That is, enhanced access to service excellence, that is known as ease framework. Now, ease framework started in January 2018. That was another set of reforms in the public sector banks after Indradhanush, and that has brought a lot of emphasis on the measurement of performance parameters of the public sector banks, and it was also known as a way for smart banking. So smart banking was pursued. Now, ease reforms have also been changed from time to time. BCG has been the consultant for the purpose of drawing out the ease framework. And ease 1, ease 2, ease 3 and ease 4. As of today, ease 4 is the framework which is being followed for the purpose of assessment of performance of public sector banks. Now, after the ease 4 is now in force, Manthan 2022 is now held. Now, Manthan 2022, there were, of course, a lot of emphasis on raising of capital by the banks directly from the market, and also there was also emphasis for reviving the lending, which has slowed down during the pandemic time, because there has not been much of demand from the borrower side, and also there were a lot of constraints on the side of the banking of the banks, and as a result, there was a huge necessity to revive the lending. These are the two aspects that have been highlighted in Manthan 2022. One is to augment capital on one side, and to increase the speed of credit growth. So these are the two things. Apart from that, there were 6 committees which have been formed to go into the operations of the public sector banks, ranging from technology, HR, governance, incentives to the employees, and how to harness the technology and things related to the operational aspects of the, because they will have to compete with the new generation banks like now a lot of small finance banks and payment banks have also come, and fintech companies have become active, and RBI has been consistently bringing non-banks also into the shadow banks also closer to the banks, and now a stage has come where a collaboration between banks and non-banks is essential. Now, way forward, we can say that there will be privatization of two public sector banks. The names which are floating in the system is Indian Overseas Bank and Central Bank of India. We will and their performance has also increased. And one notable feature that needs to be recognized is the improvement in the performance of banks in the during the 2 year of pandemic period, and now the banks are relatively in a better position as far as capital adequacy ratio is concerned, as far as asset quality is concerned. Asset quality has also improved and has come down. Of course, now the challenges of post-pandemic period will create some near-term challenges as far as the public sector banks are concerned. But more is to come as we move forward in the public sector bank space, and they will be continue to contribute significantly to the upliftment of the economy and also revival of the economy in the post-pandemic stage. So, as far as the reforms of public sector banks are concerned, the progress right from Narasimham Committee 1, Narasimham Committee 2, then Indradhanush, then your Manthan 1, that is 2017, which brought ease reforms, ease 1, ease 2, ease 3, ease 4, and now Manthan 2022. When we put together the measures which have been incorporated at every stage in the reforms, I think public sector banks are going to look better, more competitive, and more customer oriented. Only thing which needs to be looked into is how we are able to gear up for the financial and digital literacy of our consumers who can be at risk due to the proliferation of cyber crimes because of the digitalization.